Hello friends, welcome back to another educational video update. I already gave you the basics of bonds in my Bonds 101 video. If you missed that and you're interested, go check it out. Today let's discuss what drives bond returns. So we're going to kind of nerd out on bonds. Stay with me here. There are several components to total return for bonds. First, the coupon. I'd say coupon income is the most important component. It's obviously the interest payments you receive from holding a bond. Historically, coupon income has been the most reliable and steady source of bond returns. Even when the markets fluctuate, like they do every year, the income you get provides stability and can help offset price declines, which is kind of confusing. When interest rates rise, prices decline, and vice versa. Let me explain. Bonds and prices have a inverse relationship, like a teeter-totter. When one goes up, the other goes down. I was going through this with my daughter for her AP macro test just the other day. And basically, when interest rates go up, if you have a 4% bond and interest rates go up to 5%, nobody's going to want your 4% bond, so the price falls and you'd have to sell it at a discount, and vice versa. So you can see how prices and rates have that relationship. Anyway, as we've actually seen in recent years, interest rates can be influenced by many things: economic growth, inflation, hello, and market sentiment. So this component is very hard to predict. The second factor, the roll down return. As a bond gets closer to its maturity date, the price can increase if the yield curve is upward sloping. Think of it as a small bonus for holding on to the bond as it moves closer to maturity. So imagine you buy a 10-year bond at 4.5%. After a year, you own a 9-year bond. You're still getting 4.5%. If there was a 9-year brand new bond that somebody could go get for 4.4%, your bond price will be higher because it's got a higher yield. Okay, moving on. Hope you're staying with us. For corporate bonds, there's something else called credit spread. This is the extra yield you earn for taking on the risk that a company might not repay its debt. So there's that. Then, if you buy international bonds, there's an additional layer of complexity: currency risk. Bond payments made in a foreign currency must be converted back into the home currency, and the exchange rate fluctuations will either increase or decrease your return. So what's the key? What's the summary? Coupon income or interest is the foundation of bond returns. For long-term investors, it's historically been the most reliable contributor to your performance, especially during uncertain times. And it's a good environment. With today's higher yields compared to the last decade of low rates, bond investors can enjoy greater income opportunities. I hope this was helpful. I hope you feel the same bond that I feel towards you. Have a great night.